Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. Today, we are going to discuss Strategic Management Accounting, Module 4. In the main topics, Advanced Capital Budgeting topics, today we'll discuss effect of depreciation on after-tax cash flow. So let's start. Before that, here a few points. Relevant cash flow for replacement decision. So how we can calculate? We can calculate initial investment. This means equal to initial investment needed to acquire net asset minus after-tax cash inflows from liquidation of old asset. Operating cash flow, that means operating cash inflow equal to operating cash inflow from new asset minus operating cash inflow from old assets. Terminal cash flow equal to after-tax cash flow from terminal of new asset minus after-tax cash flows from terminal of old assets. So, okay. Then capital budgeting as intersection of finance and accounting. It is true that capital budgeting is within all of the financial terms. For example, within the finance, corporate finance is interrelated with capital budgeting, managerial accounting, also accounting, all are the intersect finance and accounts. Okay. So here, overview of the stage of the corporate capital budgeting process. So we know, first of the identification, then rough stage hurdle risk feasibility studies, then selection, details, cash flow, risks, capital staff, implementation, mostly NPV payback period, authorization, capital rationing, and target, ranking, strategy, return, and risks. Then implementation plans, setup, responsibilities, milestone, expenditure, selling, meetings, and performance measurement and control. Before and after start, during implementation, after implementation, that was post-audit. Now, the effect of depreciation on after-tax cash flow. Look, after revenue and cost are determined, taxable income and income tax needed to be calculated. Tax calculation can be very complicated, but here we just address the basis. Usually, in a specified time period, total cost deducted from total revenue gives the taxable income. So, cash flow after tax, the analyst calculate the after-tax earnings of the investment of project and then add back the depreciation charge. Depreciation counted as a cost that acts as the shield to diminishing the tax effect. Look here, investment in cash outflow No cash adjustment, no tax adjustment because no adjustment necessary. Cash flow does not affect taxable net income. Working capital cash outflow and inflow, no adjustment necessary. But revenue cash inflow require the adjustment with tax rate. Look here, multiply by 1 minus tax rate. Same to expense cash outflow, multiply by 1 minus tax rate. So before and after tax cash flow can be calculated by this way: revenue minus opportunity cost minus capital cost, then we get before tax cash flow. And from before tax cash flow, if we deduct income tax, then we'll get after tax cash flow. I think it's okay to you. So look here, return on investment analysis must be based on the net cash flow after tax. That's why it is very much important for a finance guy. Depreciation is not is depreciation is a non-cash item, but used to determine the cash flow of income tax. Look here, effect of depreciation, revenue 20,400, less cost of goods sold 10,000, expenses excluding depreciation 4,700, and depreciation 2,000. So net profit before tax 3,700. If we deduct the tax of 1480, then we'll get net profit after tax 2,220. And again, we should add back the depreciation that we deduct before tax. So net after tax cash flow would be 4,220. Clear? So depreciation expense, reduced tax liability, is that it is acceptable to the DCT, or that means tax authority. Generally, it is included as a part of operating expense. However, it is non-cash based expenses. Therefore, depreciation is added back to net profit after tax. Okay, here, look an example. Cash flow after tax. If I pays 1 lakh for a machine at time 0, and the machine can start producing goods and generating annual revenue 38,000 with operating cost 12,000 from 1st to 10th year, and the salvage value will be 0 with income tax 25%. In this case, before tax cash flow would be, look here, revenue 38,000, okay, less operating cost 12,000, as mentioned in the question. Capital cost, that's initial investment, 10 lakh, what's it, 1 lakh. So before tax cash flows, look here, in each year, that means in the year 1, 26,000, up to 10 years, 26,000, 7 every year. So if in trial and error basis, if we calculate return on revenue, we'll get 22.6% before tax cash inflow. So, okay. In this hypothetical case, the investor is allowed by tax law to recover the out of the pocket cash capital cost, depreciation, and gradually deduct the from taxable income. One way to calculate the taxable income for each year to distribute the capital cost of 1 lakh equally over the allowable depreciation lifetime, 10 years. And the after-tax cash flow would be determined. Look here, revenue, operating cost, depreciation, 10 years for 10,000 for 10 years, because there is no salvage value. Okay, so taxable income, this one, 16,000, and there were 26,000. Income tax, 25%. That means 4,000 each year up to 10 years. So net income after tax, 12,000 per year. Then again, we have to add back the depreciation, 10,000. So after tax cash flow, 22,000 every year. So this way, the taxable income for each year would be 16,000, which gives the tax. That means here we calculate 4,000 as income tax. Okay. So after tax cash flow, 22,000 in every year. And this way, we can calculate return of revenue and after tax cash flow, 17.7%. So look here, that was 22.6% before tax, and after tax cash flow is 17.7%. So I think it's okay. So what's we think we learn from here, the depreciation effect is a major part. So look at other problems. The management of FYR is considering 5 years contract to build scientific instrument for a large district. The initial investment required to purchase production equipment, 4 lakh, to be deducted over 5 years using the straight line method, 5 years straight line method with no salvage value. Okay. An additional 50,000 is working capital required for the contract. Working capital will be returned to FYR at the end of the 5 years. So working capital will return after 5 years. Annual net cash received and daily operation are shown. Amount 50,000, 60,000, 120, 2 lakh, 1 lakh 30,000. It is cash receipt minus cash payment. Okay. So management estimated the required rate of return 10%. And corporate tax rate is 40%. So based on that figure, we have to determine which cash flow are affected by the tax rate and why not. This is the question. How companies adjust for income tax when evaluating long-term investment. This is the theoretical question. Now there is a question based on the information given. You should accept the investment proposal. This is the question to you. So in the theory side, which cash flow are affected by the tax rate and which are not? We look this addressing the following: budgeting, investment in cash outflow, working capital cash outflow and inflow, revenue cash inflow and expenditure outflow, depreciation, investment cash outflow. So when tax are involved, it is important to understand which cash flows are affected by the tax rate and which are not. We look at this addressing the following capital budgeting item, and the initial investment not affected. Working capital not affected in the beginning year. Revenue and expense affected. So need the adjustment. So okay. And the calculation, if we can, NPV with income tax for FYR. Look here, the purchase of the machine, initial investment purchase price, and working capital do not directly affect net income and therefore are not adjusted with income tax. So purchase price of the machine 4 lakh, working capital 50,000, annual after tax cash received, amount equals net cash received multiplied by 1 minus tax rate for year 1, 30,000 equal to second year, third year. This way, calculation 30,000, look what? 50,000 comes into 30,000 after tax adjustment, 3672, then 1 lakh 78,000. And here, the working capital release after 5 years. So total cash in and out. Look here, the payback factor at 10%. Multiply that, we'll get present value. And this is the net present value is minus maybe 6,146. The NPV is negative. Since NPV is less than 0, reject the investment. So, is the investment decision is negative. Okay. Another thing, the part of that question, if we are a car repair company, another subsidiary of FAR, purchase new machine to take a for dollar for lakh dollar. The machine will have a life 4 years, no salvage value, expected to generate annual cash revenue 1,80,000. Annual cash expenses excluding depreciation will total 20,000. The company used the state line depreciation method and has a tax rate 30% and require rate of 10% as like previous one. So find the NPV of the investment. Should the company purchase the machine? Is the question. So come the same way, if we purchase after tax cash revenue adjustment with the tax rate here, look, 30% tax rate, same to expense, have to adjust. The depreciation, calculated depreciation, the tax shade, depreciation expense multiplied by tax rate, depreciation expense is a 1x equal to 4 lakh divided by 4 years. The annual depreciation saving 30,000. That means 1 lakh multiplied by 30%. So here the depreciation. So total cash in or out and PV factor if multiply, then we'll get, if you sum it, then we get 50,112, which is the positive. So yes, the company should purchase the machine, the positive NPV, that is 50,112, should run the proposal is the company's recurring rate of 10%. So I think today's project capital budgeting process. In the capital budgeting process, a mutually exclusive project is one that shows acceptance, preclusion acceptance of the another project, while an independent project can be accepted even other projects are also accepted. So in the capital budgeting process, our corporate goal, based on the corporate goal, need to do the strategic planning, find out the investment opportunity, make the preliminary screening, financial appraisal, quantitative analysis, project evaluation or project analysis. Then I have to do the quantitative, qualitative factors, judgment and findings. Accept or reject decision on the project. If accept, then implement. If reject, go again in the top side. Implement and facilitation, monitoring, control and review. After that, continue expanded or abandoned project and then post-implementation audit. So this is the capital budgeting process, the fundamental process. So the student, thank you with financially putting eLearning. We will meet again. Take care. Allah Hafiz.